Welcome to The Explainer. Today, we are diving into a metric that you see everywhere in finance, the EV to EBITDA multiple. So is it some kind of brilliant shortcut for finding a bargain, or is it a dangerous trap just waiting to spring on you? Let's figure it out.
You've probably heard this one before, right? It's a classic rule of thumb in investing circles. The idea is so simple. You see a low number, say under 6, and boom, you've found a cheap company. It's meant to be a quick and easy filter. Well, here's the thing about rules of thumb. They can be super misleading. Relying on just one number without understanding the story behind that number, that's how you walk right into what we call a value trap. So let's dig into why that happens.
Okay, so to really get why this can be a trap, we first have to understand the bait. Let's break down the two pieces of this famous multiple.
First up, you've got enterprise value, or EV. The best way to think about this is that it's the total value of a company's main business, its core operations. And the way you calculate it is you take the market value of its stock, you add up all of its debt, and then you subtract whatever cash it has on hand. But hold on a second. Why are we subtracting cash? You'd think a big pile of cash makes a company more valuable, not less, right? This is a question that honestly trips up a lot of people, but there's a really solid logical reason for it. And that reason boils down to one single word: consistency. See, the EBITDA part of the multiple stands for earnings before interest, taxes, depreciation, and amortization. Now, the interest you earn from your cash pile, that's not part of EBITDA. So to make sure you're comparing apples to apples, you can't include the value of that cash in the enterprise value either. It's all about making sure the top and bottom of the fraction are speaking the same language.
And right there, that's where the beautiful simplicity starts to crack. Because if you subtract cash to be consistent, what about other stuff? Like what if the company owns a piece of another company? The earnings from that aren't in EBITDA either. All of a sudden, this simple metric opens a whole Pandora's box of complexity.
So, if we can't just rely on a simple rule, then what really determines whether a company's EV to EBITDA multiple should be high or low? What are the actual hidden drivers of value?
Well, it really comes down to these four things. It's the combination of a company's tax rate, its growth prospects, its overall riskiness, and how much money it has to plow back into the business. That's what really matters. So let's break them down one by one. First up, the tax rate. Now remember, EBITDA is a pre-tax number, but as an investor, you only care about the cash you get to keep after taxes. So it's pretty straightforward. If you have two identical companies, but one is in a country with a higher tax rate, it's just going to be worth less. And because of that, it's going to trade at a lower multiple. Next, we've got growth. This one's pretty intuitive for most people. Investing is all about the future, right? So the faster you think a company's profits are going to grow, the more you're willing to pay for it today. That's why you see these high-flying tech companies trading at way higher multiples than, say, a slow and steady utility company. Then there's risk. Think about it this way. The more volatile or uncertain a business is, the higher the return you're going to demand for putting your money into it. That higher required return, what the finance nerds call the cost of capital, pushes the company's value down right now. So, more risk equals a lower multiple. Simple as that.
And finally, our last driver, reinvestment. And honestly, this is the one that trips almost everybody up. It's not just about how much a company earns, it's about how much it has to spend just to keep the lights on and grow. A business that has to constantly buy expensive new factories or a whole new fleet of trucks is going to have way less cash left over for its owners, and you can bet the market is going to hit it with a lower multiple for that.
So now we've got our four drivers. Let's put them to the test with a real-world example that just perfectly shows what can happen when you ignore all this stuff and just follow that simple rule of thumb. Okay, so here's a table of trucking companies from a few years back. You can see the multiples are kind of all over the place, but there's one name that just jumps right off the screen at you: Ryder Systems. Look at that! Just 2.91 times EBITDA. Ryder looks unbelievably cheap. It's less than half of that 6 times rule we talked about. There was even a research report around that time saying this was a major reason to buy the stock. Seems like a total no-brainer, right?
Wrong. It wasn't a bargain at all. The market knew something that the simple multiple was hiding. Turns out, Ryder Systems had the oldest fleet of trucks in the entire industry.
You see, that low multiple wasn't a signal of a great deal. It was a massive, flashing red light. The market was telling you loud and clear that a huge amount of reinvestment was coming right around the corner to replace all those old trucks. That number wasn't saying cheap. It was screaming danger, high reinvestment ahead.
So,
If EV to EBITDA isn't a shortcut you can rely on, then how are you supposed to use it? The trick is to just completely change how you think about its purpose in your analysis.
Instead of seeing it as the final answer, you need to think of it as the starting point of your investigation. So first, you see the multiple. Then you immediately start firing off questions based on our 4 drivers. Does this company have a crazy high tax rate? Is it a super low growth business? Is it incredibly risky? Does it need to spend a ton of cash just to stay in business?
And this, right here, is where you find the real opportunities. A true bargain isn't just a company with a low multiple. No way. It's a company that has a low multiple but doesn't have any of the issues that should cause it. You're hunting for that mismatch. A healthy, growing, low-risk company that, for whatever reason, the market has put in the bargain bin. That's where you find real value.
So, the next time you hear somebody bring up a low EV to EBITDA multiple as a reason to buy something, don't just ask, is it cheap? Instead, ask, okay, but what's the catch? Because using this tool the right way isn't about finding a shortcut, it's about knowing exactly where to start your homework.